why don't we make this a little simpler? Instead of you giving money to the bank, let's remove the bank. Very nice. And the bank giving money to businesses, let's remove the businesses and simplify this a little bit and replace this with this guy. Look at him. Perfect. I think he needs a loan to get a new phone, a personal loan, and he has the money. So perhaps this money can be given straight to him. He can give an 18% return to him, and for this service, I'll take 2%. So why don't you guys? Perfect. So I'm a P2P lending platform. Very simply put, people who have money lend it to people who need the money for an interest rate, of course, up to 20%. He gets his loan, he gets a great return, and I get a really nice juicy cut. Now, over here, I have one more feature to tell you. Are you ready? Apart from the great returns if you give a loan, you also will get daily returns, which means you don't have to wait for a long time. You'll get a credit every single day. And of course, all of this can be done through the app. So download it, finish your KYC, and start investing right now. What are you waiting for? Download it and begin. Oh my God, not again. There was something definitely wrong with that pitch. And I also noticed all these comments over here saying, P2P lending batao. So in this episode of De-Influencing, we thought, why not we pick the topic of P2P lending? We'll talk about the good, we'll talk about the bad, because certainly these guys won't. So let's start with step number 1. What the hell is P2P lending? So first I'd like to say, there's nothing wrong with the P2B business model. In fact, like most financial products, they all have their own risk curves and reward curves. The problem comes when you perceive the reward to be too high and the risk to be too low. The truth is, everything has risk. So in this episode, we'll talk about the risks of P2P so you understand how it is, especially since it's such a new product. But before we go there, let's start by understanding how a bank works. I'll oversimplify the banking business model, but let's quickly go through it. We have a bank which takes in depositors from people like us who put in their savings account. So the more savers they have, the larger the deposit. The bank also needs to put this money to good use. So they give this out to other businesses. Now this could be small businesses, could be people, could be sole proprietors. And the difference over here is what the bank keeps. Now what a P2P lender does is he wants to sort of remove the bank from the picture, remove the businesses from the picture, and say, why don't the transactions happen between people? You have peer 1 and you have peer 2. This guy needs a loan, this guy has some money. Simply match these two people, give the loan, and peer 2 gives it back with a piece of interest. This guy's happy because he made some extra money with that interest. Everything's working. Isn't this nice? Directly person to person. But of course, there's one thing. How do you find such people? Who keeps track of this? Who does the KYC? How do you do this actually? Because you can't do this on an Excel sheet. Enter the P2P platform. Its job is very simple, and I'll show it with a phone. The platform digitally matches such people, maintains the records, and does everything to enable such a transaction. Interesting, right? Now in India, P2P is fairly new, but it's been around for a while in China. In fact, in 2012, P2P started, and boy, did it boom. There were so many people offering 10-12% returns, which was massive when compared to banks who were giving much less, and this was 4x or 5x of what you could get at a savings account. And as you can imagine, the number of P2P platforms swelled to 3,000, and there were billions of dollars being transacted through such platforms. But like all things, it seemed very shiny and nice and beautiful on the outside, but inside soon the ugliness was revealed, and China found out that over 40% of these platforms were actually not real. The transactions weren't happening correctly, and they were Ponzi schemes. So the government entered, shut down one of the biggest P2P lenders of the time. That was almost a $7 billion fraud. So naturally, the public in China lost trust in such platforms. And as you can imagine, few years later, the number dropped. And in 2019, P2P lending was banned. But see, this problem is not there in India. India has regulations. In fact, the RBI calls them P2P licenses. And this started way back in 2017. And we have about 25 registered P2P lenders. You can actually find the list in the description from the RBI. So the problem isn't with the business, it's how it's marketed. As recently as 2023 December, the RBI stopped a bunch of malpractices on how these products were marketed. The first biggest risk is low credibility of the borrower. I mean, a loan book is only good as the creditworthiness of who it's given the loan to. Think about the borrower. This person probably didn't get a loan through its traditional methods like a credit card or through a bank, and he has no option left but to come to such a platform to get this money. There also could be some desperation for this person. I mean, why is he agreeing to pay such a high interest rate on the loan? Does he have financial pressure? And we know the people who have financial pressure are the most desperate. There is no collateral, and the chances of this borrower defaulting is relatively much higher. The second risk is the NPA risk, or the non-performing asset risk. Now, we all know the economy goes through boom and bust cycles. When everyone's being paid salaries on time, when things are going well, the system will auto-deduct the money and hopefully the loan will be repaid and you should be okay as an investor. But what happens in a time of crisis? Let's look at COVID or any other time like 2008. At that time, will this individual borrower actually be able to pay? Since there's no security, the chances of this NPA rising is very high. For example, during the COVID period, microfinance companies had a very high double-digit NPA because they were unable to do business. They were individuals. They came from backgrounds where it was impossible to repay. And for that period, the risk became really, really high. As an individual, can you actually handle such a high risk? In fact, one of the largest P2P lenders in Europe, called Mintos, has an NPA of about 9 or 10% normally. And during COVID, this went all the way to 22%. Did you know there's such a large risk in something like a P2P platform? Again, there's nothing wrong with the business model, just people don't know that this exists. If you did or you didn't, put it in the comments. I'd love to know what you think about it. So how does an NPA affect a person? Let's suppose a person invests 1 lakh rupees in a P2P platform, and this 1 lakh rupees gets automatically divided to 100 different loans. Now let's suppose out of these 100 different loans, 100 people, 5 people don't pay back anything. That 5,000 rupees, 5 multiplied by 1,000, is gone to zero. So now whatever returns you'll get on the 95,000 rupees because the other became absolutely zero. This is why NPA as a measure is really important. Another thing we noticed on the internet is that people compare bank FDs with P2P investments. I can maybe guess why this happens. They both sound like they're fixed. They both have some tenure. They both have this feeling that you're giving some money as a loan and getting some return back, very similar sounding to bank. But bank FDs and P2P investments are completely different. They're not the same. I mean, these guys over here are unsecured. This is not backed by anything. And the returns aren't fixed. It can vary. You could get NPAs, some people may not pay back, etc. So we don't know actually what the returns are until you actually get them. And in the case of bank FDs, there is an insurance of up to 5 lakh rupees by the RBI. So there is a difference. These two can't be compared. And finally, we have a little flaw in the business model of the P2P lender too. And it's called liquidity risk. Very simply put, we have a lender who has given money and we have a borrower who's taken the money. Now, in some cases, the P2P platform is giving a daily payout to the lender. Now, this sounds great as marketing, but imagine this. If the lender is getting a daily payout, but the borrower is not paying daily, then this is a mismatch. What happens when the withdrawals increase, but the input actually decreases? Where will that extra money come out from? So the next time you see an advertisement that says up to 36% returns, you know the risks involved. Especially you guys. I'm talking to you who get that message every first with a salary credited and want to make that quick buck and think 30%, 20% is ginormous and you should use this opportunity to make money. Please think, assess the risks, breathe a little bit, and understand the possibility. First, make sure you understand every asset class has risk, including this one, and it should be part of a portfolio. It can't be a major part because the risk in this is obviously higher. Second, understand that this is a new kind of investment product. We're all still figuring this out. The regulators, the investors, the platforms, and as time goes by, this will become a little more clearer, a little better, but you have to do your job in understanding risk. And third, don't forget to subscribe to 01, hit that subscribe button, tell me what you thought of this episode, and what other things should we de-influence. Tell me in the comments below, hit that like, and see you in the next episode. Dialogue ही नहीं पता मुझे, मैं acting में खो गया. In this case, मुझे लगा यहाँ पर आ रहा है, यहाँ पर आ गया. Tries to compare a new kind of second